All right, if you're a high income earner who is self-employed, then this video is for you. Let's jump right into it. I'm an entrepreneur and I use the self-employed wealth ladder to direct my $50,000 to $100,000 that I invest every year. There's 4 rungs to the ladder. The first one is all about safety and stability. The second one is all about long-term wealth in retirement. The third one is about accelerated freedom through retiring early with very specific investments. And then finally, the last stage is kind of like a graduation where you have extra money now and you can splurge it on your lifestyle and things that you enjoy. Step 1 is all about safety. Chances are, if you're a high earner, you probably already have quite a bit of money saved up. This step of the ladder just provides that security and stability that you need by having extra cash on hand. Being self-employed, we never know if money's going to keep flowing in, so it's very important for us to have a large emergency savings. Emergency savings should be about 12 months worth of expenses, and that's just to keep your lifestyle exactly how it is today. All this money you're going to put in a high yield savings account. That way you can earn a little bit of interest, but it's completely liquid and you have it whenever you want. I put all of my money into Wealthfront for my high yield savings account. It earns about 3.5% right now, which is much better than the 0.1% that I get through Wells Fargo. So this gives you security to start investing your money, and you don't have to worry about losing your income because you have a lot of runway to figure out what to do if something happens to your business. So you're stable, you're not stressed out, and now you have a nice base of money that you can rely on, and now it's time to start investing for the future. Step 2 is all about saving up for retirement. And since right now a SEP IRA or solo 401k, you can start withdrawing from starting at 59.5 without any penalties. So the game plan is really to save up enough money to where when you're 59.5 or 60, you have the income you need to retire and live off of for the rest of your life. The simple calculation is that you can withdraw 5% of whatever you have saved up. So if you're looking for $100,000 a year, you need $2 million. If you want $200,000 a year, you need $4 million. And so you want to work backwards from age 60 to where you are now and figure out how much money you need to invest in order to reach your goal. I just use the long-term average for the stock market of 10% for my planning purposes. So at age 60, if I want $2 million, right now I'm 37, that would mean I need about $245,000 in the stock market. The strategy here is pretty simple. Use broad market index funds, 80% into US stock market and 20% into international. This shields you from volatility from the US stock market, or the international stock market gives you a mix of both. But over the last 50 years, there's been decades where the US stock market has done better. There's been decades where the international stock market has done better. So this blends both of them, gives you a little bit less of a return, but also a little bit less risk. I have everything set up through Charles Schwab, and that's where I put all the money for my retirement in. I've been fortunate enough to be investing enough money where I'm done investing for my retirement account. I already have enough money in it to reach my goals. Now I'm focusing on the step 3 in the ladder, which is accelerating my freedom by retiring early. The goal here is just to retire as soon as possible. So putting together a strategy that's going to help you go from today to retired before age 60. At this step of the ladder, we have a lot of money invested in cash, in a high yield savings account. We have a lot of money invested in the stock market. Now, this next part is to diversify our portfolio a little bit more and investing strictly in real estate. Although you can trade public REITs, which are companies that are investing in real estate, they tend to follow the stock market, so I stay away from those public REITs and instead focus on a few other things. Now, for this step, you need to be an accredited investor. That can be something like making $200,000 plus a year as a single person, or $300,000 plus a year as a married couple. Or you can also have $1 million in assets as long as you're not including your primary residence. My primary focus for this step is real estate syndications and private REITs. A real estate syndication is basically an entity that pools together money from investors to buy real estate assets. Their goal is to buy that asset, improve it, and then eventually sell it for a very good return. A lot of times the plan will be to double the equity in 5 to 7 years. Private REITs are very similar to public REITs. One of the biggest differences is that a public REIT is available to be exchanged publicly, whereas the private REIT is typically only available to accredited investors, and it's much less liquid. You can't buy and sell it whenever you want. It's money that has to be stored up for a while. The advantage to the private REIT over a public REIT is typically you're chasing higher returns and you're also looking for a nice cash flow. So for planning purposes, the real estate syndication, I plan on doubling my money every 5 years. And for the private REITs, I'm planning on an 8% cash flow each year. The goal here is to keep investing the money. Any returns you make, you're reinvesting, and you're doing this until you hit your early retirement goal. The more money you can invest each year, the quicker you can accelerate your returns and the quicker you can retire. So although you may be passing up on that brand new Tesla or that brand new Mercedes-Benz, You are focusing on retiring earlier, and you can delay those things just a little bit longer. Earlier this year, I bought an $80,000 vehicle, and I kind of wish I didn't. I think that was a mistake. I wish I put that money into real estate because ultimately I care a lot more about retiring earlier than driving around in a nice car. So if I were you, I wouldn't make that same mistake I did. Take that money, put it into your early retirement fund, and just wait because you'll be hitting it sooner than you know, and you can buy that nice car once you know you're completely done investing. Step 4 is really just about expanding your lifestyle. You've done all the investing, you've done all the saving. Now you can splurge on that new car, that fancy trip that you wanted to go on, and you don't have to feel guilty because you've already hit all your goals and you're set. So this is my personal investment strategy on how I'm planning on building wealth and how I'm planning on retiring early. If this is something that you want to follow along with and learn more about, make sure you subscribe to my channel because I'm going to be posting content all about this. If something here really resonates with you and you plan on doing something very similar or exactly the same, please comment below and let me know what you're doing because I'd love to hear from you.